Hey everyone, thanks for joining. Super excited for today's chat with Tyler. We're going to let folks funnel into the room before we get started. A couple things I want to go through before we get started. A lot of you already sent in questions. Awesome, thanks for those. Keep submitting them throughout the webinar as they come up. We'll either interject or answer them at the end. You can submit those. There's in the link in Zoom below, there should be a Q&A button. You can hit that. You can get on Twitter at #VisibleWebinars or email Matt directly at matt@visible.vc, and we will answer all of your questions. And if we don't get a chance, we'll do our best to even email and follow up after the fact. So that's Q&A. The next thing I want to talk about is throughout this, we'll mention different resources. We'll be posting those live, so you can click on them. But also, this is going to be completely recorded, so it'll be live for everyone that wants to get a chance to go back and look at it. We'll have a recap. So Tyler and myself send it out to our respective email lists. So if you don't get a chance to catch the entire thing and want to go revisit a topic or share it with someone else, we'll make sure we do that as well. We're going to give it maybe 30 more seconds, and then we will get started. Tyler, you're recently moved to Mexico City, correct?
I am, yeah. Less than 2 weeks ago. So I'm actually
awesome.
in a WeWork here with a pretty cool,
wow.
view over the city. Yeah.
That's awesome. What prompted the move? I know you've been working remotely for a while.
Yeah, I mean, I've always, well, at least for the last nearly a decade, built every organization that I've been a part of as kind of remote first, and that worked out really well when I married my wife Anne, because she works in the State Department, and so she gets sent to these really cool posts. We spent about 2 years in Rio de Janeiro, Brazil, recently, and now Mexico City. So she picks the places, and I just get to tag along, which is pretty fun.
Yeah. Fantastic. All right. Well, let's get started. I think we got a good amount of people in, and I want to welcome everyone. Like I said, we're really excited to have Tyler joining us today. For those of you that don't know me, I'm Mike Pruce. I'm one of the founders of Visible and run things day to day here. We're also a remote first company. We help startups engage investors and find investors. So whether you're trying to update current investors or find new investors for your business, we help manage all that through our platform. We got introduced to Tyler because they're one of our customers using Visible for Earnest companies. So that's in full disclosure before we dive in. And we'll get into Tyler's background here in a second. Tyler is the general partner and the founder of Earnest Capital, which is really providing an alternative form of capital for businesses. I know we titled this, Tyler, Alternative Capital, and then as I reread the Fund 2 memo, you're like, I don't like that term. It's really more about value investing. So at the last minute, I went through and actually updated it to value investing for startups.
It's fine. You're not alone. A lot of people use it, but we'll talk about this later. But I had a background in clean energy, and for a long time they called it alternative energy, and it's a very self-defeating prospect to sort of pigeonhole yourself like that. So I'm trying to rebrand it, one person at a time.
Well, we're starting with the attendees today and myself, so we're getting there. Awesome. So I'll touch on Tyler's background, and you could probably do a better job of yourself, Tyler, than I can introducing yourself. But as we touched on, Tyler being remote first, currently calling Mexico City home, started a company called Store Mapper and sold it. And as you just mentioned, really interested in climate change issues, clean tech and solar, travel bags and gear. We could probably spend a whole webinar on that. I'm very much into that as well. Rock climbing and mezcal. So maybe Tyler, just walk us through your history and your journey so far, and we'll touch on that.
Yeah, I mean, like I mentioned, I started my career in the clean tech world. So I worked for a startup that was helping investors invest in renewable energy. I was not a technologist per se. Didn't do a computer science degree and didn't really get involved in software startups until later in my career. But did get a firsthand experience in finance and with an interesting startup. Went through an acquisition. We were acquired by Bloomberg. So I ran a clean energy an energy economics group at Bloomberg for a couple of years before I basically finally realized in my career that I wasn't really cut out for a 15,000, 30,000 person organization, which was when I sort of transitioned my career. So I started off actually getting a firsthand experience with what it's like to have a fundamentally good idea for a business that involves kind of code and software, and to try to raise venture capital and to sort of think of that as the only default option. And then to, basically end up pitching about 500 plus investors and never really, we raised a small angel round for a company called SolarList, which was at the kind of intersection of my experience in clean tech and then extrapolating that into software. And so we raised a small angel round and then just totally failed to sort of get liftoff, in part because I felt like, this company involved code and, we need more money than we had. So I guess we should pitch VCs, and only later learned that, hey, actually, there's a lot more to it. I switched gears, taught myself to code, bootstrapped a much more sort of niche B2B SaaS business and ran it as a sort of part-time digital nomad, fully remote team, and grew that. And through that, I was super fortunate to meet a ton of other founders who were doing something similar, basically bootstrapping businesses, learned about how powerful those businesses can be once they're really at scale, but also how hard it is still at the very early stages. I basically, the seed round for StoreMapper was a pretty significant pile of credit card debt, which turns out to be a pretty common story. But and
so,
then
when was this, by the way? Roughly just time frame, so we kind of understand where you were at this time.
So I sold StoreMapper about 2.5 years ago, maybe nearing closer to 3 years. In the summer, I think it'll be 3 years, and that was after running it for just over 5 years. So 8-ish years ago was when I sort of shut down my last solar startup and started learning to code, wrote the first lines for the next business.
Awesome. And it seems like even probably in those last 2 years, there's just been a huge just increase in velocity, just in terms of kind of that your story, right? The digital nomad, bootstrapping, indie hacker type group. Is there any, do you have any data off the top of your head in terms of just like the velocity? I'm sure you have like a ton of your own data points, but like any hard data around that?
I wish we did. There's a couple of communities that are clearly growing. So if you look at like Indie Hackers, which is a big community that's dedicated to that, you can sort of watch all the numbers just sort of, going up and to the right and accelerating. But one of the quintessential challenges of targeting the market that, is sort of the bootstrapper market is that there's such a data availability bias towards venture funded startups, because you have the investors that have a portfolio and you have LPs and all that sort of stuff, and they have this big incentive to actually build a data set of, all these companies, how many are there, how many are getting financed, how many are failing, those sorts of things. And with bootstrap startups, you have the opposite. In many cases, you have a lot of entrepreneurs. It's only recently that this kind of movement towards transparency has really kind of taken hold, inspired by, a couple of great entrepreneurs and then organizations like Indie Hackers. But a lot of times, if you're a really successful bootstrapped entrepreneur, the last thing you would do was tell anybody about it, right? So it's very challenging to get a sense of the whole market, but it's pretty clear that it's all growing,
do you think that that's because people were maybe in the past like had a badge of shame that they were not like venture backed, and that they were bootstrapped? Is that but it seems like that's certainly changing. The tide is changing with that, though.
I think there's just no incentive, right? If you're run a really successful hedge fund and you figure out like a particular sort of arbitrage strategy, you don't go write a long blog post about it, right? And so that was just the default case for people who found out, hey, there's this one little niche part of the market, and I built some software that people pay for it, and you'd never think there were enough customers here, but actually I make $10 million a year on this business. It was only until a couple of entrepreneurs started to really lean into transparency and show that there are upsides to transparency that some people started, including myself, I saw that and felt that I was better off despite some of the, the challenges of just like letting the secret get out, And so it's just the default position. I think if you're not fundraising from other people, you really don't have a ton of default incentives to share when you are being successful at a business,
Yep.
So.
Awesome. So some already great questions streaming in around Earnest and some of the dynamics and types of companies. We're definitely going to get to that. I think it's going to be important to touch on a couple other things around why Earnest exists, and we'll get into some of those great questions. So keep them coming in. Let's talk about the Founder Summit real quick. I think this is really interesting. Something that you guys are hosting here in a couple months in Mexico City. How is it going to be different than any other founder conference? What are you hoping to get out of this first conference that you guys are putting on?
Yeah, I mean, so I would say there's kind of two main reasons why we decided to do a conference or a summit. The first one is a little bit selfish in the sense that Earnest is this interesting experiment where we're totally remote first. The team is remote. Probably 2/3 of the founders we've invested in, I've never met in real life. We have this really active community of like Slack groups of, and the same goes for probably the mentors, who are this group of about 40 incredible entrepreneurs who are super successful. They invested in the funds, they're invested in the portfolio companies, and we're all just hanging out in this remote community. And I really feel like those communities are strengthened, even though I'm a big proponent of remote work. I think there's a reason why remote companies are, almost all of them do big team retreats, is that, those communities are really strengthened when you have at least one opportunity to really get together in person, hang out, just kind of put faces to names, that sort of stuff. And then for us, what we want to try to do is just the big challenge for me is that Earnest is necessarily selective. Not everybody can, get invested in, and not everybody can invest in the fund. And so, but we have this broader group of entrepreneurs who kind of like what we're doing and are also remote. And so this is in part just an experiment to try to bring the community together, to start to put some pillars of in real life around the remote community. And then the second thing is, I like to do what I call just shake the Etch-a-Sketch, and just see if there's like a product that we can just totally shake to a blank slate and redraw it the way that we want to do it. It's been the process of the financing instrument and some other things that we'll touch on. And for me, I enjoy going to conferences, particularly as a remote entrepreneur, but I often find that I enjoy like about 7% of them, like a lot. It's kind of like the little moments in the hallway, and then it's mostly about the interaction with the other entrepreneurs. It's not about somebody standing up there in front of a PowerPoint giving the same content that they could give on a webinar or a podcast.
Totally.
And I don't get much value out of that. So what we're trying to do here is this, experiment where we have basically no speakers. Almost everything that involves someone up front and everyone looking at them is workshop interactive structure. A huge amount of the agenda is just focused on small group discussion and just a lot of time to just have fun and build relationships. And so, less so that I took away 7 Facebook ads tactics, and more so that there's 4 people that, 7 months later, when I'm having a really rough time with my business, I feel comfortable just like hopping on a phone and talking it out with them. So it's an experiment. I mean, we're doing a lot of things. We're no speakers, really, no sponsors. We're just kind of doing it our way in Mexico City, and we'll just see how it goes.
It's gonna be awesome. I think we just went to 2 offsites a year because you can't replicate the like in-person energy you get with folks. We're like remote first as well, and we keep kind of changing our offsites to always just improve on them, but it's really awesome just being able to connect with everyone in person. So I have an inkling it'll be successful, and that you're going to probably get begged to do another. So Founder Summit, check it out if you haven't already. We're going to get into some content now. Questions keep coming in, Q&A at the bottom here. Email Matt or go on Twitter, and we'll get started. So the way I'm breaking the agenda down is like kind of starting at the highest level first, like what does Earnest believe in, and why does Earnest exist? We'll go through some differences of Earnest and venture capital and revenue-based financing and some other options out there. We'll talk about the shared earnings agreement, which is something that Tyler and Earnest have created, and correct me if I'm wrong, but have also open source. So this can be used by not just Earnest anymore, but anyone can really take the agreement they've put together and put it to use. And then we'll talk about kind of transparency and investor updates and some of the ways Earnest is using Visible in a self-serving way to us today. But I had a chance to go through the draft memo. It's like 10,000 words, so it took me a little bit to get through both of it, but it's awesome. And there's three things I pulled out that I thought were really interesting about what Earnest believes in. The first being the macro movement and this really interesting idea that software is now entering the deployment age. So we'll have Tyler touch on that. The lever of change, the peace dividend of the SaaS wars. So why, and Tyler and I were discussing before the webinar, like this might be the most important part of all of this. So we'll really dive into that. And then the tidal wave of earnest entrepreneurs. So we'll talk through each of those three things specifically today. We'll also in the recap link to the memo if you want to read it in its entirety. There's a couple more really interesting sections in there. But Tyler, let's get started with this idea of entering the deployment age. And I would love just to get your thoughts on like, what makes you believe we're entering this deployment age of software, and what does that actually even mean?
Yeah, so I mean, there's kind of a lot to unpack in the idea. So I'm going to just gloss over it for these purposes and try to touch on more what it means than the entire underlying theory. But it starts with this, often cited, particularly among the venture capital world, book by Carlota Perez, basically where she talks about the kind of technology cycle or the cycle of adoption of new technologies. And it's this kind of like pretty common, S curve that you see in various other places, but she breaks down a couple of interesting phases of that, and then also digs into what does that actually mean. And she became kind of, I think, really popularized among venture capitalists for talking about the installation period, which is the kind of like when new technologies are developed, what happens is you get these kind of frenzied bubbles and all kinds of crazy like adoption processes that are, she argues, necessary. So she got really popular when there was this constant question of like, are we in a tech bubble right now? And a lot of people would say, hey, look, Carlota Perez makes this incredible argument for even if we're in a bubble, it's actually good because it's a necessary and normal process of this ramping up of accelerating and getting new technologies kind of to market and to scale. What I think is really interesting, and basically this is mostly just standing on the shoulders of an amazing post by Jerry Newman, who's an investor in New York, who wrote this post about how software specifically is currently transitioning from this installation period, the kind of crazy, bubbly, who knows what's going to work. If it works, it's going to be a winner take all market, to the deployment age, which is the next phase, which is a lot more focused on, okay, we have some of these technologies more or less kind of down, and now it's about distributing them into every corner and pocket of the economy and every opportunity there. And that's kind of, interesting. I think it makes a lot of intuitive sense. You think about other technologies from previous generations. The question is like, first of all, are we in that moment right now? And I sort of basically agree and make the argument that yes, we are making that transition right now in the world of SaaS, software-enabled marketplaces, digitally native brands, that you're seeing these businesses that are being built that are just not going to be a Salesforce or a Shopify. They're not going to stake out a winner-take-all vertical. They're just going to be able to build, incredible, niche, sustainable, profitable businesses. One of the main consequences of that transition, that is the reason why I highlight it, is that usually it's accompanied by a need for a new sort of capital. So one common example is once we got a lot of the modern post-industrial technologies like televisions and modern automobiles and things like that, what happened was, you needed complementary forms of capital to sort of push it all throughout the economy in the form of like consumer credit. Is when you get the invention of, in-store layaways and, financing. You get a lot of innovation around retail leasing, to make it more efficient and more cost effective to open new stores, to be the delivery mechanism for this, and that is kind of, goes hand in hand with this transition. And so that's an argument that we sort of make at the very, very high, lofty level that entrepreneurs don't care about, but like that essentially we're going through that transition right now with SaaS and software. And what we need to do is to really rethink what are the quintessential forms of capital. The terminology that they use is this transition from financial capital to production capital.
Yeah.
Financial capital in this example would be like traditional venture capital. Production capital is still being defined, I think, which is the moment that we're in right now. So it's a little bit of like what Earnest is doing. It's a little bit of like what you're seeing with a lot of, Stripe and Shopify and Square all offering merchant financing, inventory financing, all that sort of stuff. QuickBooks is trying to offer me, a loan now. Like that's also part of this transition in production capital. So.
And is your argument that, venture capital shouldn't exist, or venture capital should exist, but apply it to maybe different innovation that's happening, not in the software world?
Yeah, like, it's the latter. Yeah, definitely. Yeah. I mean, I would say almost every, I am definitely the occasional bomb thrower about, you shouldn't raise VC for this and this reason. But actually, if I'm talking about it, like the actual context for that is not like VC is inherently bad. It is, I think, as the default / only choice for software businesses, it is bad. Right? In the sense that it should probably still be there as an option for some software businesses. It should definitely be there for a lot of markets that I don't know as well, right? In terms of self-driving cars and synthetic biology and, trying to create, delicious synthetic meats and stuff like that. That's all, in the wheelhouse of venture capital. But I think that the opportunities in software are increasingly, a larger and larger percentage, even as that top of the pie grows in terms of total number of opportunities. More and more of those are not venture scale opportunities.
Yep.
My basic argument.
Makes total sense. Would you say, like, a counterpoint to that, maybe let's just look at WordPress, for example, right? I think probably everyone has run on WordPress at some point for your marketing site. And now it seems that like there's a lot of newcomers like Webflow and other folks where you could argue that's a software business, but maybe deserves to raise venture capital because they are going after WordPress now, and it does require intense capital to get it out there. Like, would you agree with that statement?
Yeah, I mean, I definitely think there are still, venture opportunities. There are still people building software businesses that should seriously consider venture capital. And it's, we'll probably talk about this later, but I mean, we go through quite a bit of effort to make sure that we don't close down that opportunity for the companies that we work for. That, hey, if they figure out actually, we think we found an opportunity here that has winner take all dynamics. It has network effects. It has the opportunity for us to, completely outspend competitors and take over the market. And we want to do that. That's aligned with our values as founders, then we say, okay, no problem. Like, we're not sort of dogmatic and saying that it never makes sense. But my position is that for the vast majority of entrepreneurs and entrepreneur opportunities that are within this kind of general framework of SaaS, really efficient e-commerce, digital marketplaces, all that sort of stuff, most of them are probably not going to see those dynamics where they should be raising venture capital, which, by the way, the best venture capitalists agree with me on this. This is not that controversial. So
great. And so I think part of that is now, the first thing exists probably maybe because of number two, which you call the peace dividend of SaaS wars, around this idea of it's so effective and cost effective to build a software business and distribute it. Why do you think this is one of the most important tenets of your thesis and draft memo, and just walk us through, why now for Earnest as it comes to this idea of the peace dividend of SaaS wars?
Yeah, I mean, so, the follow-up question to what we were just talking about, right, which is that, okay, a whole bunch of businesses are, the opportunities are in niches. So it's a great opportunity to build a $20 million, $50 million business, or a, single founder, 1 million ARR business or something like that. Okay, great. You think those opportunities are most of the opportunities, and you think that makes them not a fit for venture capital. Well, okay, can you actually invest in them and earn a good return? Because venture capital does have this really well-defined dynamic of, hey, look, most of these businesses are going to fail, right? Almost all these things are going to fail. So we need the 1 or 2 out of 10 that don't fail to be huge successes, so they can make up for all of the massive failure, right, that happened in the portfolio. And so if we're going to make this work and be able to actually make investments at a similar stage in terms of, 1 or 2 founders, a little bit of traction, not yet, don't have a team, don't have, proof that they can get there. How can we feel like we can do that? And the reason why we feel like we can do that is the peace dividend of the SaaS wars. And the peace dividend is it's a little bit of a tortured metaphor because people use peace dividend for a couple of different things. But one of them is this idea that, like, when you have these big wars, like let's say like World War II, we developed all this cool technology because people were just throwing money at stuff, right? It was like, hey, I have an idea. We're out of rubber, and so we need to make more tanks. So whatever amount of money you need to build synthetic rubber, just go do it. And lo and behold, we got synthetic rubber. And then the war ends, and now we can be like, oh, cool, now we have synthetic rubber. Like, maybe we can make better tires for like everyday consumers with that, right? And then that's the idea of the peace dividend, is that there's this acute inflection point where people are throwing money at stuff and they're creating a lot of technologies, human capital, literal capital, that then actually, once that moment has passed, we kind of can just take advantage of. And in this case, it's a bunch of stuff that was developed, as there was this kind of, starting in probably like 2000, this like escalation of winner take all SaaS markets. And it's stuff like open source frameworks like Ruby on Rails and Laravel and stuff like that help you quickly start it up. It's like scalable infrastructure. So you can start on, Heroku or DigitalOcean basically for free. You don't have to go and rack $1 million worth of servers to just get started. You have all these dynamics that make starting a SaaS business easier, lower risk, less capital intensive than it was, basically any time period ago. Even 18 months ago, it's gotten easier with things like serverless and things like that. And so that's the basic premise, is that we now have all of these tools at our disposal that we can go and say, hey, there's this very niche opportunity over here where people are still using spreadsheets and sticky notes. And, I think there's maybe 5,000 total B2B customers in the country. But actually I can build a fully functional SaaS for 100K, and I can build a whole SaaS company for 500K in total, mix of outside capital and sweat equity and whatever. So it doesn't matter if the total potential market is only a $20 million business. I can go after that now. And that's the basic opportunity of the peace dividend. So
awesome. So we have, this idea of shifting from financial capital to production capital, the peace dividend of all of this work that's been done before. Let's talk about the entrepreneurs now themselves, and this idea of the tidal wave of earnest entrepreneurs. This is, I think, really a fascinating part of the memo, and would love just to have you touch on this a little bit, and then we'll kind of break into the dynamics of Earnest and how it works.
Cool. Yeah. I mean, so I think this is the most exciting part of what we're seeing, which is, we were talking earlier about how difficult it is to see the whole market of these software entrepreneurs, because no one is really tracking them in aggregate. But there's a couple of dynamics going on right now, which is, one of the things a lot of people don't understand is, even though entrepreneurs, in terms of, the founders of kind of, multi-billion-dollar companies are so dominating the culture and the zeitgeist, that actually we're in the middle of a multi-decade decline of entrepreneurship writ large, right? And this is this graph that's here that I don't have the total answer to why new business starts are continuing to sort of fall off a cliff. But one of, I think, a credible solution here is that most of the new opportunities for entrepreneurship are in this category of sort of software enabled. So I think about a generation ago, when I was growing up in Pensacola, Florida, a fairly small town, the rich people that you knew in town who were not doctors and lawyers were entrepreneurs who, they built a chain of, auto dealerships, or they built a very successful, regional chain of health food stores and things like that. nowadays, the opportunity for those entrepreneurs is to build, a dedicated niche CRM for auto dealerships and sell it across the entire country, or, an on-demand inventory tracking system to make sure you have maximal freshness at every health food store out there. These are great businesses. Amazing, much easier to scale. I think about, my dad's business running a guitar shop and having to build a physical building, fill it full of guitars, and then open the doors and see if anybody wants to buy. Super risky, not nearly as easy to scale, right? But there's a big problem, which is that these businesses are unfundable, or have been unfundable in the sense that they don't have any collateral. So you cannot go get any kind of a bank loan for it. Your business is a GitHub repo and a Stripe account. They can't underwrite that. And then on the other side, a lot of these businesses are not a fit for venture capital. So who is providing the startup capital for these businesses? And in my opinion, and the experience of so many other founders, it's been nobody. It's been, just a friend and family, a rich uncle who can write you a $50K check to get you off the ground and also let you live, rent free for 2 years, that sort of stuff. Or, in many cases, it's kind of, very scary, but, taking out a ton of credit card debt and stuff like that. So there just really hasn't been an alignment of startup capital with entrepreneurship in the way that there was, if you think back to like the 70s or the 80s. You're like, hey, I'm really smart about this industry. I understand, whatever, ham radios. I want to go open a ham radio shop and I'm going to need $300,000 to build it and buy inventory. You can walk into a bank and get a loan and start doing that. And there's no version of that right now for entrepreneurs. So and on the other side, you have people who are running these businesses. It's more and more starting to take root in the culture that this is the new American dream, is to run a profitable, remote-friendly, sustainable software business that, you can have 10, 15, 20 employees, pay yourself a comfortable salary and throw off, 10, 20% in profits every single year, distribute it to your employees. And then at some point, if you ever want to, there's, private equity funds waiting in line to give you a life-changing exit if you want to sell or not, And so I think what we're seeing is really entrepreneurs recognizing that, hey, this is the new American dream, is to raise these kinds of, or to start these kinds of businesses. And what we are trying to do, and what we hope other people will help us do, is create a startup capital that's really aligned with that. So that's the idea. Hopefully it's a title.
I love it. Yeah, I would encourage everyone to go read that section if any of them. It's I think really fascinating and resonates probably with a lot of people listening in today. So let's talk about, great. So we kind of had this idea now, and so Earnest uses what they call a shared earnings agreement. And there's some kind of key factors in this agreement. And Tyler, I'll let you walk through how it works, but really there's this idea of how much Earnest will invest, then the percentage of shared earnings, and maybe touching on what shared earnings actually are. There's the founder earnings threshold, and this is kind of a lever that plays a role in all this, and then the valuation cap and maybe why that's important. And maybe just walk us through each of these things, and then I'll probably break, and we've gotten a lot of questions around dynamics and types of companies, so I think that'll be a good time to jump in and do a little preemptive Q&A, and then we'll continue to maybe breaking down the model in the next slide here. But let's just start with, I mean, you do this every day. Where do you want to start? Do you want to start with shared earnings and what shared earnings are?
I'll talk a little bit about why it exists. So, and then I can talk about what it is specifically. So basically, we, in sort of 2018, really started working on the idea of Earnest in, seriousness in earnest, whatever, feeling like there was enough interest from LPs, limited partners, to potentially invest in the fund and to actually get this off the ground. And the first step was, hey, a lot of folks you would think as like the sort of quintessential company they want to build is something like Basecamp or Wildbit or Gumroad or something like that. And so we say, okay, the standard quiver of options for, early stage investors, like a SAFE or a convertible note or something like that, it's just not aligned with those outcomes, right? If I had written, the Basecamp folks, a $250K convertible note that, is only really even equity if they raise another round, well, whatever it is, 14 years later, they've never raised another round. They're wildly profitable. They're making substantial distributions to the owners and the employees, and I'd be sitting here getting nothing, right? So
Yep.
the first step we had to do is to create a financial product that aligned us with those kinds of outcomes, so that a couple of those kinds of outcomes that would be bad under traditional terms, we can also kind of high five and encourage them to want to pursue those as well. So the two ones are a steady state profitable business that's throwing off distributions, and the other one is a sort of kind of an earlier sale, right? So if you raise 100K and then later you get an offer for like $5 million, you still own almost all the company. That's a life-changing exit. Most venture funds are structured in such a way that they are very highly incentivized to either literally be able to block that sale or to strongly encourage you not to take that sale. So those are two scenarios that we wanted to be very aligned with. So the process was basically thinking through all of those, outcomes and scenarios that the business could go in, and trying to say, okay, what terms can we put at the beginning to where no matter if you decided, hey, I think we want to raise venture capital. Hey, I think we need to grow this business and reinvest every dollar for the next 7 years and not be profitable. Or, hey, I think we're 2 years in and, we're growing about 20% a year. So we're just going to make the business super profitable and take nice dividends. Or, hey, we want to sell this business, right? Any of those, we wanted to say, okay, well, that's going to be a win for us. So we're not going to need any control over your business. And, we're also going to be excited about those outcomes. If it's a win for you as a founder, we want it to be a win for us as well. And so the gist of that was we sat down and kind of designed this structure. And then I started shopping it around to some potential investors and founders and say, hey, I think people are going to like this. It's going to resonate. And all of them said, well, how do you know if they're going to like it, if founders are going to like it? So I said, fair point. And so in October of 2018, we basically just open sourced it, published it at Google Doc with comments open and everything, put on Hacker News and Indie Hackers and everything like that. We got hundreds and hundreds of comments from folks giving us feedback on it and that sort of stuff. And over time, we've kind of tweaked elements of it, but I would say the gist of it remains largely the same. So what is it? Essentially, you can think of it as there's a sort of safe. So all of the convertible pieces that a lot of people will be familiar with, in the sense of if you ever raise another round of equity or you sell the company, you can kind of do some basic math using the valuation cap and the equity conversion terminology and how much we invested. You can kind of simple division and figure out, okay, in that instance, Earnest would get 7% of the proceeds of the sale or something like that. All that is relatively standard. And then we do is we layer on top of that this idea of shared earnings. So the idea is there are going to be certain scenarios in our portfolio where founders are going to have the opportunity to just pay themselves $1 million a year, right? And they're not going to want to reinvest every single dollar into more and more and more Facebook ads. They're just going to say, you're going to take the profits. And so we also want to be incentivized for that to be a success for us. So we define this idea of basically a modified profit share. Basically says, when you are generating what we call founder earnings, which is significant founder compensation and profits, we're entitled to a piece of that up to a capped multiple of our initial investment. So we get that as you decide to generate it. So it's not like debt, there's no repayment schedule. It's just like, hey, if you run the business very successfully, you pay yourselves $1 million that year, in some mix of salary and dividends, we might be entitled to 25-30% of that up until we hit a sort of capped return.
And that's where, that's the threshold, correct? So you're defining that, and then once you're above that threshold, that's when you are getting that piece of the shared earnings.
Right. We wanted to define it as a percentage of founder earnings so that we're totally aligned with the founder in the sense that we're always getting a function of what you're getting. But what we didn't want to do is in the early days, you're paying yourselves, $50,000 a year. Well, we don't want a piece of that. Right. So what we do is we set a sort of threshold below which our piece is zero. And then once you start getting the business to where it's really generating significant economic interest for you as the founder, then we get a piece of that. But again, as a founder, you can say, nope, we have too many growth opportunities. I'm going to pay myself, kind of a minimum amount and reinvest every dollar in growth, in which case, we get zero for that year.
Yep. Got it. So the founder can say, you know what, I'm reinvesting all this back in the business. We're not going to pay out any dividends, in which case you're not participating either.
Right. And then the last piece of the puzzle, so what we wanted to do, because we take no control of business, no board seats, nothing like that, we have to feel that we're aligned with the founders so that there's no way they can kind of game the system, right? Which is something you can do, right? Like a common one is, investors are only entitled to dividends. So if you wanted to, as an investor, as a owner of the business, you could say, well, I'm paying myself $1 million a year in salary, so there's no dividends. Sorry, right?
Yep.
So we wanted to try to smooth out those edge cases. And one of them is that the shared earnings payments and the convertible piece interact. So when you initially get an investment from Earnest, if you turn around and sell the company, a month later, we might get X%. And as you make shared earnings payments to us, that percentage gets reduced over time. So you have an incentive. If you ever going to sell the business, maybe you want to pay some shared earnings along the way, or if you're growing really fast, that's fine. We just say, okay, cool. We keep our kind of higher percentage, but that's great because we all agree you should reinvest that money and we should all just grow the business, right?
So you're not taking a board seat. What if I want you on my board? Like, how does that work? Like, I think part of the alignment, right, is providing help and advice and sense of community with other people in the Earnest family. Like, how can you just talk on some of the support and what you're bringing to the founders on top of just capital?
Yeah. So, I think we would cross that bridge when we come to it in terms of, we invest very early stage. So I don't think it makes sense to have a controlling board, like one that actually votes on stuff until businesses are very, very later stage. If someone in a portfolio wanted us to join in that capacity, it would, we would definitely not be opposed to it. We'd think about it and see if we had the time and all that sort of stuff. But we do create what I think is the most valuable piece of a board at the early stage, at least, which is just the advisory aspect, just having experienced people on hand to be able to bounce questions off of and ask advice of. And that we replicate, I think, really well with this idea of a mentor network. So we have a really active, both a Slack and a Basecamp setup. So some people prefer just hanging in and quick fire questions back and forth. That happens in Slack. Other people want to ask really long multi-paragraph, discussions, and that happens in Basecamp. But both of those is a community of all the founders in the portfolio, as well as at this point, it's about 40 really experienced, mostly like bootstrapped software founders who we called like skin in the game founders. So they every single one of them invested in the fund, so they have skin in the game, and they're allocating time to to answer questions basically. And we do a lot of mix of stuff of like office hours and things like that. So we have a daily weekly check-in with all the founders. It's just like a Zoom call like this. Everybody can just kind of talk about what they're working on, anything they need help with, what they're hiring for, blah, blah, blah. And then we take that audio and we put it in a private podcast that the rest of the portfolio and the mentors have access to. So somebody who's maybe running their own company, right? We've got folks like some of those companies I mentioned, the founders of Basecamp, Wildbit, Gumroad, those sorts of things. They're running companies, they can't spend all day, every day, but they can go to the gym, they can listen to the podcast, they can realize, oh, so-and-so is hiring for, this particular HR role. I know someone who's perfect. Let me just fire over and help out, right? So we do a lot of stuff like that. Yeah.
Cool. So we're getting a lot of questions, which is awesome. I'm going to break them down in kind of two different categories. So I think there's like the firmographic type questions of like, what kind of companies are you looking for? And then we'll get into more specific kind of company details like stage and kind of breaking down the amount investment. But if it's cool with you, Tyler, I'm just going to start with some direct questions from some people that wrote in here. So I'm on my phone. That's what I'm looking at here since I don't have the dual monitor set up. How vital do you feel is it for a company to be a C Corp versus an LLC? As a 3.5-year-old LLC, we prefer to avoid structural changes. If the alt to VC community doesn't have a strong preference. So Joe wrote this in, like, basically, do you have to be a C Corp or LLC, or do you not care?
So we are fine investing in LLCs. The strong preference for C Corps among venture capitalists, as far as I understand it, I don't have the most in-depth understanding of that, but it's around the fact that they intend to own preferred equity and they prefer the kind of investor protections and rights that are entitled to preferred equity in a C Corp versus an LLC. because we basically never sit on the cap table unless you do actually raise for venture capital, and then we have some equity. But you know, the default scenario would be you only raise from us or other seal investors, and you either pay shared earnings or you sell the company. So throughout that entire life cycle, we never actually own shares in the business except for right during the sale transaction. So we don't really care. I will say, you know, one of the things we're working through with some really talented experts right now are the sort of tax implications of doing something new. And so there are, I would say, more tax questions and complexities around doing what we're doing with an LLC than a C Corp, just around some really complicated, like partnership basis accounting that frankly, I'm still wrapping my head around. But my default is always like, I want to create alignment with entrepreneurs first, and then I will deal with the complexity later. But no, we invest in LLCs. A significant majority of the companies in our portfolio right now are LLCs. So,
is you know, when applying to Earnest, is being like remote an issue? Like, should you be at least US based to make it easier, or are you agnostic to locations and where that company is founded and headquartered?
Nope, we invested in 13 companies last year. One is based in the UK. One is in terms of where the founders are physically located. One is based in the UK. One is based in South Africa, and the other one is based in New Zealand. And so, you know, from an investment perspective, we definitely do not care. I think, you know, as a lot of people have discovered with remote communities, remote employees, et cetera, you know, having really significant time zone differences does make it challenging to take advantage of some of the, you know, non-cash benefits of Earnest, in the sense of, you know, if our weekly, you know, all founders check-in is going to be, you know, at 4 a.m. for you every single week, it may be a challenge, but we are agnostic to where you're located, and we do have a preference for US-based companies and entities, although we have done one investment in the UK, so it's not a deal breaker for us. And we do have one of our portfolio companies is called First Base, and they're exceptionally good at helping people open US-based entities. So if you're, you know, you're based in Germany and you're okay with whatever the tax consequences of just setting up a US LLC or a C Corp, you know, we can help you do that, and we would have a slight preference for that. But otherwise we're super remote first. I mean, I'm in Mexico City right now. So
So speaking to that, Scott wrote this question in. I think it's great. We certainly fall into this as well. Many bootstrap founders employ remote independent contractors into key roles and have few or no employees. You know, do you view this as a potential threat to the business and scalability? And does this impact your investment decision?
No, it doesn't. You know, I'm super comfortable and familiar with that strategy. I would say a huge number of our mentors also do something, you know, similar, or did at one point before transitioning more into full-time employees and things like that. No, I will say, so I'm sure some other questions will touch on this, like what's the, you know, right stage for investment and stuff like that. I do typically want to see the internal capacity among the founding team to sort of get the product built. So I will say I am more skeptical of, hey, we're a pure B2B SaaS business and there's 2 founders, and neither of which are technical, and we have like one contractor, you know, in Ukraine who's basically building the entire company. Still not a deal breaker for me. I think we can wrap our heads around it. But yeah, I mean, I would like to see the internal capacity among the founding teams to at least move the product forward. You know, make sure that they could at least support the MVP level of product, basically.
So let's talk product and the stage. I think that's where a lot of questions are streaming in. So, you know, you've done 13 investments, and I'm sure that the answer is it ranges and it varies, but is there a common thread in terms of like what stage that company's at? Maybe talk to us about recurring revenue, and growth rate. Maybe like what is like a sustainable growth rate? I think, let me find the question just so I'm doing it verbatim here. How much does the growth rate of a business guide your investment decision? What do you view as substantial for an investment? So maybe touch on kind of where are companies when you're investing in them, and then both in terms of like absolute recurring revenue, and then like maybe growth rates associated with that.
Yeah. Okay. I'm going to bucket this into a couple things. First is like, what's the sort of minimum, right? So
Yep.
what is not too early for us? And that we have like an FAQ on our website. It's like earnestcapital.com/FAQ. And that one of the first questions there is like, okay, what's, too early, or what do we want to see at least at a minimum? And what I basically say is I want to see something in each of the three buckets of, can you build it? Will people pay for it? And can you grow it? So literally, can you actually build the MVP? I don't want to see, hey, we want to raise $100,000 and then turn around and spend it on a dev shop that's going to build the first version of this product for us.
Yep.
We see some level of internal capacity to build the product, some level of proof that your target customer will pay for it. So, hey, we did one AppSumo launch at 97% discount, and we got 500 users. I don't care. Like, I want to see some amount of people paying full price and being satisfied with the product, even if it is like MVP and beta users and stuff like that. And then can you grow it? Basically, have you found at least like one channel that is beyond like, the 20 people from my former company are now customers, like some way that is beyond just your personal network, to actually, generate growth in some kind of consistent way. You don't have to have, 7 different channels up and running and all profitable and CAC to LTV ratios and all that. But I do need to see something there. So that's kind of like the minimum. And within that context, I mean, we've literally written investments into solo founders that have basically coded an MVP on nights and weekends. They're at, $1,500, $2,000 a month in revenue, right? And they're looking for the check to, basically quit their job or stop freelancing. So we were very comfortable going right up to that line in terms of early stage. So where do we want to play across the board, not just the minimum? I would say I'm very focused on Earnest solving real problems that don't have other solutions, right? So if you are already at 50K MRR and you've got a team of, 20 people, and, you are looking to get, $100,000 to finance, an ad campaign, you've got a lot of options. You could go to your bank, you could go to ClearBank, you could go to all kinds of stuff. We don't really want to play too much in that space, right? Because, we just don't want to be competing with a million different things. We want to be solving problems for entrepreneurs that are broadly unsolved. So usually we're sort of anywhere between those brackets, I would say. So up to, the kind of 50K, maybe even a bit more as we're starting to experiment with about there. But once you're at like $1 million in annual run rate, you're definitely out of our wheelhouse in terms of that space. Usually what we do is we solve 2 problems. It's literally founder runway. So founder wants to just get back their full-time focus. Or what we end up solving is like some first critical hires. So, you've got to 10K MRR, you're 2 founders and 2 contractors, and you're kind of break even. You want to hire like a really good engineer or a head of marketing or someone to take you to the next level. And you just can't, accumulate the cash reserves to go and make someone like a real competitive offer. Those are the 2 points where we find that we add the most value, basically.
Hiring when it hurts, I think is what you call it in the memo, right?
Exactly. Yeah. Hiring when it hurts, I think is in general what we expect the entrepreneurs who are sort of aligned with us to do, is to get to a point where they're like, we really need to hire this person. We're not like going to go raise a boatload of money and hire 20 engineers just to have them around. And so those are the 2 opportunities. The last piece is around growth. And this is one of the things where I think we operate very differently, and we try to talk to people about what our investment thesis is, particularly in contrasting with other ways of investing early stage entrepreneurs. We think about the kind of metrics of the funnel in the inverse to what you would normally see like a seed VC think about it. So seed VCs, I think in general, will be very interested in like top line growth rate, how many people are coming to your site, how many people are sort of signing up, blah, blah. And then, okay, average revenue per user, not that important. Churn, I mean, obviously you can't ignore it, but like you can solve churn later. Like I want to see, 7% week over week growth, like whatever Y Combinator talks about. And that's my signal. I go the opposite direction. What I want to see is that, hey, you're not going to have a massive budget to spend on growth. So you need to make every potential customer count. So I want to see super low churn, nice high average revenue per customer, nice high, like, you know, implied lifetime value, you know, a huge percentage of people who actually try the product convert from like a free trial to paid, right? And then I'm less concerned about growth. Similarly, everything in the stack matters. We much more prioritize low churn, high average revenue per user, high conversion from free trial to churn, because that makes you feel comfortable that you're not going to be continuously looking for capital for growth. You don't have a leaky bucket that you're going to have to funnel lots and lots of customers in to grow. If you sign people up in 10s and 20s at a time, you're going to keep a ton of them. They're going to pay you forever. So it's going to be efficient to do whatever kind of marketing channel makes sense, you know.
Awesome. I want to touch on this one because it's actually come up quite a bit. I want to be respectful of your time too, Tyler. I know we have 5 more minutes. Maybe that bleeds over.
Yeah, I can go longer.
Cool. So let me pull it up here. There was a Medium post written by a gentleman named Matt Wensing, I believe, and he kind of breaks down the seal. Like, are you cool talking about that? I know you replied directly in that Medium post as well. With kind of your comment and commentary, but like, you think that was a fair representation or maybe inaccurate, or just like, you know, anything that you're willing to share? If you're not, that's totally cool too, since I think it was a counter argument to a seal.
Yeah, I mean, one of the things that we've done is try to be absolutely radically transparent. I understood from the get-go that there would be skepticism from the bootstrap founder community about investors and forms of capital and stuff like that. And I thought the only sort of antidote to that was to be just massively, you know, effusively transparent. And so when we introduced the seal, you know, like I said, we had comments open everywhere for people to talk about. We created an open spreadsheet that anybody can copy, that can plug in the numbers and see precisely how it would play out for their situation. There's like a 45-minute video where I go through, like, with the spreadsheet, with the terms, like line by line, every single decision behind it and what it means and all that sort of stuff. And so what we've tried to do is to say, look, however you're going to compare, you know, what we're doing to other things or to bootstrapping or whatever, like, you know, in theory, what you should do is just take all of this transparent toolkit that we've given you and just look at it for your own specific use case, and then kind of make a decision about whether or not that looks attractive to you or not. One of the challenges about releasing shared earnings agreement, as you can see on the screen here, is that there's no numbers in there, right? It is a structure in which you still have to, an individual investor has to take into account their strategy, their beliefs about the world and all that sort of stuff, and the specific company they're dealing with, and plug in appropriate numbers. And you can construct, you know, incredibly onerous, horribly high cost of capital versions of a seal, and you can construct incredibly generous, ludicrously low cost of capital versions of a seal by just plugging in different numbers relative to the company, right? Even the same numbers for radically different companies would not make sense, right? So it makes it incredibly hard to do like apples to apples kind of transparent comparisons. I replied publicly to that particular article. Yep. I thought it was a pretty just flat out wrong interpretation of what we actually see in terms of writing seals. So, you know, but it's a hard task to do, right? Because you, without a specific company and a specific investor, you know, to say, well, here's what we think is fair in terms of numbers, to just kind of put in random numbers and come out with, okay, well, here's the cost of capital. Well, what does that mean? What is the context of the investor and the company that we're talking about? I thought that particular post put in very ungenerous assumptions and then writ large, you know, sort of conclusions about the seal. And I responded about that, but, you know, like I said,
I think that's totally fair. And I'm applaud you for replying. And it's hard to build something in the public eye. That's for sure. I want to go through, well, you know, we don't need to go through this. This is kind of just taking the seal terms and breaking into a spreadsheet. I would recommend, we're going to put this in all of the recap stuff. And if you want to check it out more, it's on Earnest's website, and you can play around with it. Like Tyler mentioned, he does a Loom overlay video and breaks everything down line by line. Highly recommend to go check that out. I think we've talked quite a bit about the difference with venture capital. But one thing I think is interesting, because you've kind of seen this play to life, is with one of your portfolio companies, Zach. They were an Earnest company and recently raised some additional capital back in January. So like, would love just to get your quick kind of 2 cents on how that went down and exactly kind of at that point of like, you can go raise venture capital after the fact as well.
Yeah, I mean, Yak is a great example of the caveat that you have to put over all of this stuff as an investor, right? Is that like you try to sort of pick your lane and stay in it and explain to people, and then you try to say what you want as precisely as you can to attract those kinds of companies and stages and opportunities and whatever. And then there's the fact that like sometimes you can't predict all that sort of stuff, and you make an investment that is sort of outside of that, right? And this is always the case. Every investor does that, and this is a kind of canonical example for us pretty early on. Yak is essentially it's an audio first kind of remote collaboration tool. You can kind of think of it as like Slack, but purely for audio. It allows you to kind of, it's called yelling across cubicles. You can just ping back and forth quick audio to each other in a way that's a lot more high fidelity than kind of sitting and typing out stuff. Really interesting. We are very much like orthogonal to everything we've been talking about in the sense of, these piece dividend SaaS wars and, niche SaaS opportunities, all that sort of stuff, is the fact that we are remote first. So we have a particular affinity for remote tools for remote teams. And I wrote this long post about how I think it's super interesting and we're an interesting laboratory to kind of test it out, because we are a remote community of remote teams, right? I mean, I would probably 75% of the founders in our community themselves run a remote team. So I met the folks from Yak after this post, and they were clearly on a strategy that was much more aligned with raising venture capital. We co-invested with Boost VC and BetaWorks in the original round, and then they went on and raised recently another 1.5 million. It's just an example of the fact that I don't believe that there is a one size fits all solution. I do think that you need to I think what we try to do is to maximize optionality for the founders, right? At the very early stage, you just don't know if this is going to be, this is a cool idea. And they were at the pretty early stage, but maybe actually there's only it only works for a couple of really, really big enterprise companies that really like it and they're willing to pay, and they kind of max out at 5 million ARR. And that's the total addressable market for it. Well, if that's what they start to get that inclination of, then they should keep that option open, right? They shouldn't be forced down the sort of traditional venture capital ratchet. But if they think, hey, I think we could be a Slack, like this is a huge opportunity and we need to raise a bunch of capital and build an incredible product. We need to keep that option open for them as well. And so I think that's, we try not to make the inverse of the mistake of what some of the other approaches of, two people with an idea, they go into Techstars and they come out, with a convertible note on a $5 million cap, and they're shoved right into demo day. And before you know it, it's just, they're raising venture capital and they're on this, one-way ratchet kind of rocket ship before they've really even figured out if it's the right fit for their business. So we try not to make the inverse.
We have a lot of questions actually about kind of putting the toothpaste back in the tube, so to speak. So we've had a couple of people write in like, what steps can you bring to take current investors over to this model, right? They've raised, call it less than $1 million. Can they take any steps to get someone into this model? And then similar to that, let me find the other question here. I think it was related to how can I, so sorry, we have a lot of related questions to this one. So how do can I reverse engineer my way into a seal if I've already raised capital? And then the second question is what are the good steps to take maybe I haven't raised any capital yet. Maybe Earnest is not the right fit for me, or there's other investors that are interested in investing. What are good steps to take a seal and bring that into practice now that you've kind of open sourced it? So let's start with maybe the last one, the latter first. So what are a good way to take the seal and bring it into practice, whether that's with Earnest or other investors?
As an investor, you mean?
Yeah, so I'm a company and I got maybe 10 close angel investors that are going to put 10K in each, and they want sealed terms. What are some practical ways that someone can put the seal into practice, I guess? Maybe if it's not using Earnest Capital. Have you seen it done before?
Yeah, good question. I'm trying to think. So we have led some rounds. So we've had quite a few like co-investors alongside us where
Yeah.
we led the round. I'm not aware of yet. I know a lot of people are having conversations around this. I don't have a solid example yet. And to be
Okay.
fair, it's still less than a year since we launched,
Yep.
of a fully independent, did not communicate with us, transaction closing on a seal. And part of that is because although we're sort of in process of open sourcing it, we have been a little bit slow because we wanted to kind of battle test some of the more nitty gritty stuff ourselves.
Hmm.
So for example, we open source the term sheet with the basic idea. Fine, you can use that. Well, you still need the definitive docs, right? Which is the
Yep.
actual, legally binding version of the term sheet. It's a little bit longer. Our version is about 7 pages versus 1 page. And I have tweeted that out. I haven't made exactly the same level of
Hmm.
making that like downloadable off the website, only because we wanted to use it in practice first and really kind of get that a little bit more battle hardened. And then the last piece is kind of a little bit more like tax and accounting guidance, which
Yep.
we do intend to, we are working through our first iteration of tax season. We're getting a lot of the case studies from all of our portfolio companies. What kind of questions do you have? What's the random thing about being a New Jersey LLC that we didn't think about? That sort of thing. Eventually, our goal is to package that up into guidance that we release publicly.
Yep.
But that's a little bit TBD. But we're happy to help anybody who wants to use it, basically. So there's a layer of confidence where we can say, hey, here's our terms, here's what we think, use at your own risk, versus here's our open source, plug and play version of using that. And we're definitely here, and we're trying to get to here, I would say. Yeah.
Awesome.
To your other question about,
and what about, yeah, like, have you had any experience going from the other way? Like, hey, I've raised capital and can I get my investors to switch over to this? Have you seen that yet?
we have done one deal with a very congenial friends and family round
Okay.
that happened in front of us. One challenge you do have, right, is if you go and raise money on a safe or convertible note and you decide, hey, actually, I think we were more like an earnest business and I think we have a trajectory to, going and being profitable, or maybe $20 million exit or something like that. The original terms are not very good, right? And then
Yeah.
we come in, and then maybe like a year or two later, we're getting access to shared earnings because they're actually quite profitable, and the original investors are sitting there being like, hey, what's the deal? Like, they're getting profits, we're on a safe, you haven't raised any rounds, we haven't converted yet, and so there is a challenge there. And I think my recommendation, I'll be curious to see what happens going forward, but I think what people should do in that situation is give those investors the option to basically convert into an equivalent seal at the time that they close that round, right? So
Yep.
to try to match the convertible terms as close as possible, and then also let them just convert into a seal to say, also, if we start distributing shared earnings, you will be entitled to kind of your like pro rata share of
Yep.
that. Definitely not impossible, as with any transaction where you're like kind of having to renegotiate it. It definitely is easier said than done. And particularly if you've got professional investors, that's a fund that, they've got 99 other investments and they're all convertible notes, and so it's going to break their process to switch. It could be challenging. Definitely you should come talk to us first before you, end up raising money on a safe, but
Yep.
it's not undoable, I would say.
Awesome. Well, that was great. I want to be really respectful of your time, Tyler. A lot of questions we didn't get to. So here's what we're going to do. We're going to send this out to everyone that registered. So we have the recording. Any questions we didn't answer, I'm going to coordinate with Tyler and try to answer those either personally back to the person who wrote in, or we'll just put them in the blog post and announcement with it. I realized our Twitters are flip-flopped, so Tyler's Twitter is next to my face when I put this slide together. But if someone wants to apply to Earnest, is the best place just go to your website and apply there?
Yeah, we are very open to cold applications. We don't.
Yep.
We're not the sort of, hey, you need to finagle some sort of warm intro to us. That doesn't move the needle for me very much at all. And so, yeah, it's earnestcapital.com/apply. There's a form there that's basically the first 15 questions I'm going to ask you anyway. So the easiest thing to do is start the conversation there, and then we take it from there.
Fantastic. And one last kind of parting question that kind of came up. Have you seen any failure rates to date, or what is to the comfort of or level of comfort you have sharing, like what has the it's only been a year, so it's pitch one, inning one of the game, but where are you seeing kind of like the trajectory of your portfolio companies and the success or not success that they're having?
Yeah, I mean, it's very hard to say, obviously, because we are extremely early on. But I'm very honest with our investors that, hey, the linchpin of our strategy here is that we will try to maximize the percentage of founders that we back that basically succeed for some level of success. We are not in the camp of most of you are going to fail, so I'm going to try to maximize the magnitude of success of the ones that don't fail. We are optimizing for a different variable. I think that aligns us better with founders, but remains to be seen. So far, we are significantly overperforming there. I mean, we've had exactly 0 failures. We've had the majority of the portfolio is now default alive, to where they are making more money than their burn rates. One of the things we do. I need to probably put this somewhere more accessible, but somewhere on Twitter, you could find a little spreadsheet that I made on kind of getting back to founder break even. So the idea of like, okay, we're going to raise as much capital, we're going to burn it either on founder runway or employees, and we'd like to, get back to break even before we ran out of money. We are seeing on average that taking only 6 months, and we usually target fund size to say, hey, I want to see a credible plan to get back here in 12 months. So we're overperforming, I think. Well, I'm not doing anything. The founders are overperforming, which is great to see. I think we are seeing early indicators that the basic bet that a basket of earnest entrepreneurs will fail significantly less often than what many people consider to be like the startup law of physics of 80% failure rate or whatever.
Yeah, awesome. Well, really appreciate your time, Tyler.
Likewise.
This will be sent out. This has been great. Good luck with the Founders Summit. That's going to be I think a pinnacle event for you guys, and congrats on just like bringing something new to market. It's hard to do, and I think it's now's the time, and so really excited to see what you guys are doing. And we just in the comments alone that people wrote in, just a lot of like, thanks for what you do, and this is needed. So appreciate you taking the time. Love hearing your story. We'll send this out, but thanks everyone for joining. And like I said, we'll try to get some of the questions back out to people that we didn't get a chance to answer. Talk to everyone soon, and thanks for joining.
Yeah, thanks so much for this. This was a blast. I will say, we're visible customers. We have all of our portfolio companies using it to kind of give us monthly updates. We wrote a blog post about why I think it's super, super valuable for folks to send out investor updates, not just to investors, but to prospective investors and advisors. It's the most valuable tactic we've seen, folks, that we make contact with them. We're really interested, not quite ready to invest. It's a little early stage. And when they then put us on their monthly investor updates, we have actually then followed up like 3 or 4 months later and closed the investment. So I would encourage folks to take a look at our article on that. And
same. We'll end with that. I think so much of investment and investing, whether you're going the earnest route, bootstrapping, or trying to raise venture capital, is about building that muscle and people are investing in lines, not dots, right? And so, I'm happy to chat anyone through that. And we're at Visible trying to build ways of different financing options for founders, right? So I think Earnest is going to be a great partner for us. But anyways, that was great. We'll end there, wrap it up, and try to get this out as soon as possible. Appreciate the time, Tyler, and have a good rest of your day.
Awesome. Take it easy. You too.
See ya.